All right, everybody. Logan Alex CPA here. I help people with their back taxes. If you want help with your offer in compromise or other tax relief strategies, go ahead and email me, taxrelief@loganalex.com, and we'll see what we can do. So today I want to build on the video I published a few weeks ago on the basics of the offer in compromise to settle your tax debt with the IRS for less than you owe. In that previous video, I went over the basics of what an offer in compromise is, what the baseline requirements are to submit an offer in compromise, the three kinds of offer in compromise, how to submit your offer in compromise, the fees required, what to do if your offer is accepted, what to do if your offer is rejected, and a lot of other groundwork topics surrounding the offer in compromise. What I did not do in that video is give you the formula for how to calculate your offer in compromise amount to the IRS. That's what you want to know, right? Logan, how much should I offer in compromise to the IRS? Should I just put $500 and see if they take it? Or are we going to go, back and forth and negotiate with the IRS in some back room or something like this? How does this all work? So I'll tell you how it works right now, because there's a lot of misconception about how an offer in compromise works. And in fact, there's some incorrect information about offers in compromise and these calculations that I've seen floating around online and on YouTube. So in this video, I want to tell you exactly how to calculate your offer in compromise amount. How does it all work? It works like this. The amount of your offer in compromise must be equal to or greater than your reasonable collection potential. So I'm going to spend the bulk of this video telling you how to calculate your reasonable collection potential. And I bet you've never heard of that phrase, right? Reasonable collection potential, what the heck is that, right? You've probably never heard of it because all the big box tax resolution shops, you call them up, you're not talking to a tax professional, you're talking to a salesperson who will promise the moon. They're not going to educate you like this. All they want is for you to bust out your credit card, pay them the money so they can make their commission. That's how it works. They're not going to explain the stuff to you, but I will. Now, just as a caveat here, this video is about the amount to offer in a doubt as to collectibility offer in compromise. That's the most common kind of offer in compromise submitted and the most common kind of offer in compromise accepted by the IRS. If you watched my previous video on offer in compromise basics, you know that the two other kinds of offers in compromise are the doubt as to liability offer in compromise, right? Where you're going to show the IRS that you don't actually owe the tax they assessed, as well as the effective tax administration offer in compromise, where you're telling the IRS, yeah, I do all the tax, and yeah, I can pay it, but still, IRS, you shouldn't make me pay it, okay? Watch my foundational video on the offer in compromise for more detail on that. Link to that video in the description below. But in this video right now, we're talking about the most common kind of offer in compromise, doubt as to collectibility, and how to calculate your reasonable collection potential so you know how much to offer. So first, before we get into the math, let's define what your reasonable collection potential is. What does this even mean? The reasonable collection potential is a calculation of how much the IRS thinks that it could collect from you, right, apart from your offer in compromise, right, such as through garnishing your wages, as well as the other administrative and judicial collection remedies available to the IRS. The IRS gives substantial guidelines on how to calculate your reasonable collection potential, which will become your offer amount. And it's an art. The guidelines themselves, they're, yay thick. There's some gray area in them. So there's definitely some room for strategy here. So what you're going to say in your offer is, okay, IRS, yeah, I owe you guys, 30 grand, 50 grand, whatever. But using your own policies, using your own math about how to calculate my reasonable collection potential, I can only pay you $1,000. And look, here's the math. I did it on your form for 433A OIC. That's the form on which you calculate your reasonable collection potential, your offer amount. You submit this form along with Form 656 and the other goodies in your package to the IRS that I covered in my previous video. So let's get right into it. How do we calculate the reasonable collection potential? Well, what you need to know at a basic level is that your reasonable collection potential has two components, okay? There's the equity component and there's the income component. And the sum of these two components yields your reasonable collection potential. So we're going to approach these two components and calculate them in turn, starting with the equity component and then moving on later in the video to the income component. The equity component of your reasonable collection potential has to do with how much equity you have in your assets, because the IRS assumes that you should be able to sell your assets, pay off any debts owed on the assets, and pay the IRS your net equity in your assets, net of selling costs and all that, to settle your tax bill. Now, when summarized in this fashion, this sounds extremely harsh. Am I saying that if you owe the IRS 50 grand, but you have substantial equity in your home, that you will not qualify for an offer in compromise? No, there's actually much more nuance to this calculation, which is why many people hire pros, right? If you want to hire a pro, email me, taxrelief@loganallen.com. So in this video, I'm not going to actually, fill out the Form 433A OIC in its entirety. I'll save that for another video, but I am going to hone in on sections 3, 7, and 8 of that form, because that's where the meat of the offer and compromise calculations are, okay? So in this video, I'm going to teach you the calculation rules when it comes to calculating your reasonable collection potential, so you know exactly how much to offer and compromise to the IRS, okay? First, I'm going to talk about how to value the assets you own that you include in the equity component of your reasonable collection potential. And then I'm going to talk about how to calculate the income component, how much you make, how much you spend every month of your reasonable collection potential. Of course, once you've done all this, you will multiply the income component by either 12 or 24. I'll get into that later. Add that to the asset component, the equity component, and that will come up with your full reasonable collection potential amount, and that will be your offer amount. So let's start with the asset component. The first asset that you will be including in your offer and compromise is cash. How much cash do you have? Cash is reported in Section 3 of the Form 433A OIC. Cash accounts include but are not limited to cash on hand, checking accounts, savings accounts, money market accounts, certificates of deposit, stored value cards, things like that. You must include in calculating your reasonable collection potential all cash at fair market value, okay? Less 1 month's worth of allowable living expenses. Less up to $1,000, okay, without your cash amount going below zero. So if you have $8,000 in cash and your monthly living expenses are $2,000, your includable cash would be $5,000, $8,000 actual cash, less $2,000 living expenses, as determined by the IRS, less $1,000 equals $5,000. However, if in the previous example you only had $2,500 in actual cash, you would simply report zero, okay, not negative $500 as your includable cash. For cash accounts, the IRS will typically request 3 months of statements for wage earners and 6 months of statements for non-wage earners, such as all you self-employed and proprietors out there. Also, if a withdrawal from an account would trigger a penalty, such as an early withdrawal penalty on a certificate of deposit, the amount of that penalty reduces your includable cash from that account. Also, note that money you submit with the offer and compromise is includable in your cash calculation. Next up is investments. Yes, your investments count toward your reasonable collection potential. You must include all your investments in the equity component here. Investments are listed out right below cash in Section 3 of the Form 433A OIC. Investments include but are not limited to investment accounts, cryptocurrency, retirement accounts, closely held stock, safe deposit boxes. Note that while cash accounts are valued at full fair market value for offer and compromise purposes, investment accounts are valued at their quick sale value of 80% of fair market value. So that's advantageous to you. Also, the tax resulting from the sale of an appreciated asset reduces your includable investment amount, as well as any penalties that would be assessed on the withdrawal of cash from a given asset. For example, an early withdrawal penalty on an IRA. Any debts secured by the asset that are in a higher priority position than a federal tax lien would likewise reduce its value for purposes of calculating our equity component. Naturally, any cost of sale, such as brokerage commissions, would reduce the includable investment amount as well. So let's put this all together here. Let's say you have a traditional IRA with a balance of $20,000. And let's say you have no basis in this IRA because you've always taken tax deductions for the contributions you've made to this traditional IRA over the years. Let's assume that you're 45 years old. So you're not yet 59 and a half. That's the age when you can withdraw from a traditional IRA penalty-free. So how do we calculate how much of this traditional IRA account that has $20,000 in it to count towards your reasonable collection potential for offer and compromise purposes? Well, first thing we do right off the bat is multiply that $20,000 by the quick sale value of 80%. So 20,000 times 80% is 16,000. So we're going to assume that we're taking an early distribution of $16,000 from our IRA. But we're not going to include the entire $16,000 in the calculation here because we can reduce this amount by taxes and penalties. What are the taxes and penalties? Well, this depends on your state, your income, your filing status. But let's assume that you're single, that you make $65,000 a year, that you take the standard deduction, that you live in California, and that you have to pay $100 in brokerage commissions to liquidate your IRA, okay, transfer fees or whatever. So what would the math look like here? Well, like I said, we start with the $20,000 IRA value, the actual value. We'd multiply that by 80% to arrive at the $16,000 quick sale value. Then we determine the taxes you owe on the $16,000 distribution. So for federal income tax purposes, your marginal tax rate, if you're assuming you're single, right, you take the standard deduction, all the assumptions I said is 22%. Okay, so 22% times 16,000 is $3,520. Now, what about state taxes? So assuming you live in California at an income of $65,000 a year, let's say your marginal state income tax rate would be 9.3%. So 9.3% times $16,000 is $1,488. Now, what about penalties? Well, for federal income tax purposes, you pay a 10% penalty on early traditional IRA distributions. So 10% of $16,000 is $1,600. For California, because we're assuming you live in California, the penalty is 2.5%. So 2.5% of $16,000 is $400. So if we subtract the $3,520 federal tax on the distribution, assuming you make $65,000 a year, right? Marginal tax rate 22%, less the $1,488 state income tax, less the $1,600 federal penalty on the early withdrawal, less the $400 state penalty on the early withdrawal, and we subtract $100 in brokerage commissions and other fees. If we subtract all these amounts from the $16,000 quick sale value we calculated previously, we get $8,892. So that is the amount you would include in the equity component of your reasonable collection potential for an IRA with a value of $20,000, given the assumptions that I just made. So as you can see in this example, having an IRA isn't necessarily a death sentence for your offer in compromise, right? In this example, the actual includable amount of the IRA is less than 45% of its actual fair market value. This is why you really need to know these rules, okay? Because I can't tell you how many clients I've had come to me and they say to me, oh, Logan, I submitted my own offer in compromise a couple years ago. The IRS rejected it. How are you going to do anything differently? And it's stuff like this, right? Lo and behold, I review the offer they submitted. And for an IRA, for instance, they just put the full value of it, or they might multiply it by 80% because that shows you that on the form. But this nitty-gritty stuff, they don't get into it. The Form 433A OIC is deceptively simple. You look at it and you think, oh, this just looks like a mortgage application or something. I just list out my assets, my income, my expenses, bada boo, bada bing. No, you have to look at the technical guidance so you know how to shape down these numbers as low as possible, right? So you can turn $20,000 in your IRA into $8,892, right? For offer purposes, like I just showed you. This is what the pros are for. Always feel free to email me, taxrelief@loganallen.com, to let me know about the situation you're facing with the IRS or your state taxing authority, and I can see if I can help. One thing about the 80% quick sale value. So technically speaking, the IRS defines quick sale value as an estimate of the price a seller could get for the asset in a situation where financial pressures motivate the owner to sell in a short period of time, usually 90 calendar days or less. And as I gave earlier in the previous example, the rule of thumb for this quick sale value is 80% of fair market value. That's right there on the form itself. However, you can't submit documentation to show that the asset would likely sell for less than 80% of fair market value if you had to sell it within 90 days. That's tough to do with stocks and securities, right, where 80% is already pretty generous for such liquid assets like that. But for other assets, you may be able to make that argument. On the other hand, the IRS could very well have reason to believe that based on current market and area economic conditions, that your asset could possibly sell for more than 80% of fair market value, possibly full fair market value in a hot market, but 80% is just the rule of thumb that's used in the vast majority of cases. Of course, an experienced professional could perhaps do some research into your situation to potentially take a position to actually value an asset of yours at less than 80%. So moving down the Form 433A OIC here, the next asset you have to list is the cash value of life insurance policy. So this doesn't apply if you have term life insurance. Term life insurance does not have cash value. However, if you have what is known as permanent life insurance or whole life insurance or variable life insurance or universal life insurance, a policy like that, then your insurance policy has a built-in cash value. You have to include that cash value in your equity component. So most commonly, right, you will likely be retaining the policy even as you submit your offer. And if that's the case, and even though you're retaining the policy, you still have to include the cash surrender value of your policy as part of your offer. If you're going to sell your policy, you would include the amount you would receive from the sale, net, of course, of any selling expenses, penalties, etc. If you plan to borrow against the policy to help fund your offer in compromise, you would include the cash loan value less any prior policy loans or automatic premium loans required to keep the contract in force. If you have a life insurance policy with a sizable built-in cash value, and of course by sizable, I mean sizable relative to your offer amount, your reasonable collection potential, then more often than not, it does pay to consult with a tax professional to help you figure out some strategies to reduce the amount we have to include in your offer and compromise with respect to your life insurance policy. Like I said previously, you can always reach out to taxrelief@loganalec.com to book some time with me. You can email me there. Just let me know in your email a little bit about your situation. All right, moving on to the next section of the Form 433A OIC, we have real estate. So real estate, similar to investments, you can take the actual fair market value of the real estate and multiply it by 80% to arrive at the quick sale value. And from that, you can subtract selling expenses, property tax arrearages, the mortgage or mortgages on the property, and any other encumbrances on the property. Now, most of that formula is pretty self-explanatory. Obviously, a lot of it is driven by the top line. What is the fair market value of the property? So I'm going to camp out here for a little bit. In determining the fair market value of a property, there are several approaches you can take. And if your equity in real estate is a sizable component of your net worth, it's probably worth it to spend some time here and really assess all the possible ways you can value your property and what valuations they would yield so you can present the lowest possible value for your real estate on your offer and compromise, okay, on this Form 433A OIC. For example, you can take a look at a website like Zillow or Redfin. In fact, the IRS has in some parts of the Internal Revenue Manual, not the part specifically relating to offers and compromise, but in other parts, the IRS specifically says that the market value of property can be determined by looking at Zillow. Okay, so you should at least check these online real estate websites. It's probably the easiest way to kind of guesstimate the value of a property. You can also check comparable sales, and in fact, this is what websites like Zillow and Redfin attempt to do in the first place. That said, the thing that sites like Zillow and Redfin tend to miss is what makes your property unique. Are there unique characteristics of your property that would cause a reasonable, unrelated third-party buyer to pay less for your property in an arm's length transaction than other properties in your area of the same size and all that? For example, if your property would require a lot of repairs before being sold for an amount similar to the comparable sales in your property's immediate vicinity, take that into account. Having a contractor come in to estimate repairs would strengthen your position on that. Think of any factors that could devalue your property on the open market and do your valuation accordingly. Other ways to determine fair market value of a piece of real estate for offer and compromise purposes is to use the county assessor's valuation. Note that in some counties, the assessor values property at 80%, in which case, of course, you would divide the assessor's valuation by 0.8 to determine the fair market value figure. You could use your homeowner's insurance policy's replacement value. Now, this may not work in your favor because oftentimes this will result in a very high value, especially if you've owned your home for a long time and construction costs in your area are high. If you have a current sales contract to sell the property in an arm's length transaction, that's pretty solid. Of course, you could also have an appraisal done as well. I would recommend gathering data from as many sources as possible so you can really build up your argument to support putting the lowest possible number on your Form 433A OIC for your real estate. Because real estate, right, we're talking about such high dollar amounts, right, especially if you have equity in real estate in your home. There are special circumstances that could cause your real estate equity to not have to be included in your offer amount, and you should think about these as well. The most common question I get when people hear this is, Logan, I have really bad credit, so I can't access the equity in my home, and I really don't want to sell my home. So because of my bad credit, can I be allowed to not put any home equity in my offer? The answer to that is generally no. You need a better reason than simply because due to your bad credit, you can't access the equity in your home. IRS could very well say, well, you could still sell your home and cash out that way and pay the IRS what you owe that way. There has to be more to the story. Simply being unable to access your equity without selling is usually not a special enough circumstance, okay? There usually has to be some other factor or factors involved. But let's say you have equity in your home and you have poor credit or some other factor so you can't access this equity without selling your home. But in addition, your child has a disability and is enrolled in a special program at the elementary school in your district, and there are no other living accommodations that you can afford in your area. You might have an argument to not include your home equity in your offer. Or if you have equity in your home, but due to poor credit or some other factor, you can't access this equity without selling your home, and the cost of moving would exceed the amount of equity you have in your home, you might have an argument to not have to include your home equity in your offer. But simply having poor credit and being unable to access your equity without selling is usually not a good reason to exclude your home equity on your offer amount. There usually has to be some additional argument or factor for why you can't just sell your home. Now, if you cannot pay your tax liability in full and you believe you have special enough circumstances to not calculate your reasonable collection potential in the usual way, you may want to consider filing your offer as doubt as to collectibility with special circumstances. Okay, you can do this by writing your reasoning underneath explanation of circumstances in section 3 of form 656. When you submit your offer, you not only submit the form 433A OIC on which your offer amount and your reasonable collection potential is calculated, but you also submit form 656 as well. I go over the other items you need to include in your offer and compromise package in the video I published a few weeks ago on the offer and compromise. Link to that video in the description below. So I mentioned some special circumstances previously, but other special circumstances could include some form of undue economic hardship, such as you are facing a particularly difficult life situation, such as a long-term illness, a pending surgery or procedure, the inability to pay your basic living expenses, old age, etc. Okay? Or another type of special circumstances is the argument that if the IRS were to collect the tax due from you in full, doing so would undermine public confidence that the tax laws are being administered in a fair and equitable manner. So that's doubt as to collectibility with special circumstances. That's if you have special circumstances and you are unable to pay your tax liability in full. Now, if you have really special circumstances and you can actually pay your tax liability in full, then the doubt as to collectibility offer that we're talking about in this video is not for you. Then you would look into the effective tax administration offer and compromise. I talked more about that kind of offer in my previous video on the offer and compromise. Be sure to check that video out, link in the description below. If you feel that you might have really special circumstances, right, and for this you would really have to document your situation correctly and make sure your argument, make your argument in the way the IRS is looking for and use the right words to explain your situation to create a more favorable outcome for you. But if you have really special circumstances for why you shouldn't have to pay your tax debt, you probably want a professional in your corner here. Reach out to me, taxrelief@loganalec.com at any time. All right, let's move on from real estate. Mosey on down the form 433A OIC and talk about the next type of asset on the list. That is vehicles. Vehicles obviously include motor vehicles such as cars and trucks, as well as other vehicles such as planes and boats. So first, you need to determine the fair market value of your vehicle. For cars and trucks, Kelley Blue Book is a good place to start. For more unusual assets such as airplanes and boats, typically an appraisal is necessary to determine fair market value. So similar to other assets other than cash, you don't have to include the full value of vehicles in your reasonable collection potential calculation. First, you multiply the value of the asset by 80% to arrive at the quick sale value of the vehicle. Then you can subtract any debt secured by the vehicle, and you can also subtract $3,450 per car in 2021 with a maximum of one car for single taxpayers and 2 cars for joint taxpayers. So just by way of example, let's say you're a single taxpayer and your car, according to Kelley Blue Book, is worth $10,000. Okay, and you have a $2,000 auto loan on it. So the math would be, first you take the $10,000 fair market value, then you multiply it by 80% to get $8,000 quick sale value. From that, you subtract a $2,000 auto loan as well as a $3,450 exemption, and that yields $2,550 valuation for your car for offer and compromise purposes. All right, let's move on to miscellaneous valuable items, which is the next asset you must list on the form 433A OIC. This includes expensive jewelry, expensive artwork, antiques, and things like that. Of course, this section is for the pricey stuff. Okay, we're not talking about cheap, costume jewelry here, or some mass-produced Andy Warhol print you got for 50 or $100. That's not what we're talking about here. We're referring to expensive jewelry, art, things like that. So you basically take the fair market value of the piece, which you usually need an appraisal to correctly ascertain here due to the unique nature of a lot of these assets. And after fair market value is determined, these can be included in your reasonable collection potential at 80% quick sale value. I will remind you at this point that you should not try to hide anything. The IRS has no problems reviewing homeowners or renters insurance policies and riders in order to identify valuable objects in your home. Now let's talk about your personal effects. This is right after the miscellaneous valuable items on the Form 433A OIC. Personal effects are basically the everyday items that fill your house. This includes your furniture, your fixtures, the junk in your drawers, your pots and pans, your clothes, your TV, your laptop, your video game console, all the things that fill your home, other than the really expensive stuff, right, in the previous section. Thankfully, the IRS provides an exclusion for these amounts. The exclusion is $9,790 for calendar year 2021. And the thing to note is that this exclusion amount is after the 80% quick sale valuation, meaning that if we divide the $9,790 by 0.8, you can actually have up to $12,237 worth of personal effects, and you would not have to include any of their value toward the equity component of your reasonable collection potential. And keep in mind, right, that all the stuff in your house is used. So the question is, how much could you sell all this used stuff for? So for most clients, right, they're not going to have to include any amount of their personal effects and furniture on all that in their reasonable collection potential due to the exclusion amount. All right, so at this point, you would add up all the calculated amounts for all the assets, as I've just described. You would put this in the Form 433A OIC in Box A at the bottom of Section 3, right below where it says Available Individual Equity and Assets. Now, one last thing about assets before we move on to the income component of your reasonable collection potential is the issue of hiding assets or transferring assets out of your name in an attempt to defraud the government. The IRS knows all about this trick. They call it the dissipation of assets. So if you have the bright idea to transfer assets to a friend or family member to reduce your offer and compromise amount, don't do it. Not going to work. Generally, the IRS will look back to the past 3 years, including the year you submit your offer and compromise, to see if you've dissipated any assets in this way. So if you submit your offer in 2021, the IRS will look at the years 2019, 2020, 2021 for any suspicious looking transfers. The IRS may even look beyond the 3 years if the tax was assessed before then. In fact, they may go all the way back to 6 months prior to the tax assessment. And if the IRS determines that the value of a dissipated asset should be included in your reasonable collection potential, and you do not include the value of this asset, the IRS will categorically reject your offer. So what are some examples of fact patterns that the IRS would consider a dissipation of assets? Well, the simplest example is if you deed over a piece of real estate to a family member, or you sell a piece of real estate and give the proceeds to a family member, right? That's pretty straightforward, right? That's a dissipation of assets. Another example is if you sold your investments to pay for what the IRS believes to be unnecessary expenses, such as a vacation or even a child's college tuition. The IRS would say, well, they could have taken out loans for that, right? Or they didn't have to go to college. That's not, strictly speaking, necessary for their health and welfare. The IRS has an extremely narrow view of what constitutes a necessary expense, by the way, and they take it to mean an expense is necessary if it is vital to you making money or vital to the health and welfare of you or your family, right? And by the latter, they essentially mean the most basic of living expenses. Another example of dissipation of assets is if you refinance your home to reduce your equity in your home, and you use the funds to pay off a credit card. And on that credit card, you're not putting necessary living expenses, but unnecessary costs, such as maybe the cost of your child's wedding or new clothes or vacation or something like this. But on the other hand, let's say you had to liquidate investments or otherwise take cash out of assets to pay for necessary living expenses, medical or otherwise. That will generally not cause the IRS to determine that the dissipated asset should be included in your reasonable collection potential because they feel that expense was necessary. Now, if you think you may have engaged in a transaction where there's a potential dissipation of assets issue, or you otherwise want professional assistance with your offer and compromise, shoot me an email, taxrelief@loganalec.com. All right, so at this point, you've calculated the equity component of your reasonable collection potential. That is what Section 3 of the Form 433A OIC is all about. We're halfway through calculating your offer amount. Now, we're going to skip the next 3 sections. Section 4, self-employed information, Section 5, business asset information for self-employed, and Section 6, business income and expense information for self-employed, because I intend to do a separate video, standalone video on offers and compromise for business owners that just focus on nailing down these 3 sections. But I know the sections and calculations I'm covering in this video apply to everybody out there. So in this video, I'm talking about the calculations that apply to everybody, or at least to most people, right? But for the business owners, I'm going to give them a standalone separate video that just discusses what they need to know specifically pertaining to being a business owner, in addition to the information I'm sharing in this video. So I'm going to jump on over to section 7 of the form 433A OIC and talk about the income component of your reasonable collection potential, or as it's known on the form, your monthly household income and expense information. So the income component of your reasonable collection potential is your monthly excess income, as determined by IRS rules and standards, okay? Not your actual monthly cash flow, multiplied by a future income multiplier of either 12 or 24 months. I will discuss later in this video when you can use 12 and when you have to use 24. Now you might be thinking to yourself, Logan, I don't have any money left over every month. My income component should be a big fat 0. Unfortunately, the IRS doesn't view things this way. While you must include all of your actual income, taxable or non-taxable, as your top line in your income component calculation, the IRS is quite stringent about what expenses you can claim against this top line in arriving at your final income component for reasonable collection potential purposes. In fact, the IRS has a set of standard expenses known as the Collection Financial Standards that generally govern the amounts you must use in calculating a few of your expenses, okay, major expenses. Later in this video, I'm going to go into detail and break down the components of this, but here is the general formula for calculating your monthly excess income, i.e. coming up with the income component of your reasonable collection potential. Here it is. First, you take your gross monthly income, less the national standard expenses, and I will explain what each one of these line items is later in this video, less the national out-of-pocket healthcare expenses, less the local standard expenses for housing and utilities, less the local standard expenses for transportation, less other necessary monthly expenses, equals monthly excess income. Okay, and that's the monthly income you have to calculate and multiply by either 12 or 24. Like I said, I'll explain which one to use, 12 or 24, later in this video. So this is how you come up with the income component of your reasonable collection potential used to determine the amount of your offer and compromise. So let's start with that top line, gross monthly income. Your gross monthly income is just that. It's the gross amount of money, taxable and non-taxable, that you receive every month. This includes the top line on your paycheck before taxes and other deductions are taken out, right? That's the gross wages on this form. This includes retirement income such as Social Security and pension income. This includes unemployment compensation. This includes workers' compensation, insurance compensation. This includes investment income such as interest and dividends. This includes income from pass-through entities such as partnerships and S corps. This includes net rental income. By the way, with rental income, the amount you include looks more like your cash flow on a property than your taxable income. So, for example, if you're taking your Schedule E taxable income, you would add back non-cash expenses like depreciation and subtract out non-deductible cash outflows such as principal payments on loans. Same thing with business income, right? You adjust your business income on your from your tax return to make it more representative cash flow than tax law. Child support is includable. Alimony is includable as well. All the income you receive on a monthly basis, you indicate line by line on lines 30 through 38, and then sum them all up in box D of section 7 of the form 433A OIC to arrive at your total household income. Don't leave anything out here, okay? When you sign your offer in compromise and you submit it, it's under penalty of perjury. Okay, so keep that in mind. All right, let's move on to the expenses now. These are also reported on section 7 of the 433A OIC under monthly household expenses. So the national standard expenses are set by the IRS based on your family size, right? So let me break this down for you. Box 39 and 45 here are the national standard expenses and the national out-of-pocket healthcare expenses, respectively. These are amounts set by the IRS that you can deduct against your income on this form, whether or not you actually paid as much as the national standards. Okay, so for example, here's a chart for the national standard expenses for 2021. If there's one person in your household, the IRS says you get to deduct $400 a month for food, $41 for housekeeping supplies, $92 for apparel and services, $42 for personal care products and services, and $148 for miscellaneous, for a total of $723. Okay, so you can put $723 on line 39, regardless of whether you actually incurred this much in actual expenses for the items that the national standard expenses cover. Now you might be asking, Logan, Okay, that's great that I can use this dollar amount even if my expenses in those categories aren't that high. But what if I actually do spend more money than, say, $400 on food every month? Can I increase this line 39 amount by the amount I pay for food in excess of $400? Well, that depends. You can make the argument that yourself or a particular person in your household ought to be allotted more than the national standard, but you have to prove there's a good reason for it, right? It's not just because you like eating out and you're fancy, right? For example, let's say that you have a particular condition that requires you to consume a special diet, and you can show, based on grocery receipts, for example, which you would have to submit as documentation, that this special diet costs more to maintain than the national standard for food. You may be successful in arguing that you should qualify for a higher food expense, but you're not going to qualify for more than the national standard simply because you choose to shop at Whole Foods voluntarily and you get delivery, 7 days a week. That's not going to fly. Now drop down to line 45. This is the line for the national out-of-pocket healthcare expenses. This amount is likewise set by the IRS, and they're an even simpler determination than the national standard expenses. They're simply based on the age or ages of each of the members in your household, and these amounts represent the amount you pay for healthcare in addition to your health insurance premiums, which are reported separately on line 44. So here are the national out-of-pocket healthcare expenses for 2021. For each member of your household, including yourself who is under 65, the amount is $68 monthly. And for each member of your household who is 65 years old or older, the amount is $142 monthly. So if there are 3 members of your household under the age of 65 and 1 member who is age 65 or older, your national out-of-pocket healthcare expenses would be $346, which is 68 plus 68 plus 68 plus $142. Like I said, as with the national standard expenses, it does not matter if you actually have out-of-pocket healthcare expenses in these amounts, right? The IRS is giving you these expenses just for breathing, even if you don't incur them. However, just like with the national standard expenses as well, if you want to claim more than the standard expenses for a member or members of your household for the health costs, you must provide documentation for the additional amounts. Note that amounts paid for elective or cosmetic surgeries generally don't count for purposes of claiming more than the standard here. All right, so those are the 2 national expenses, the national standard expenses and the national out-of-pocket healthcare expenses that are reported on lines 39 and 45 respectively of the form 433A OIC. For these expenses, like I said, you can deduct them against your gross income on the form, whether or not you actually incurred that much in expenses. If you want to take more, you got to document it and have a good reason. So those are the national expenses. The other standard expenses are called the local expenses. And unlike the national expenses, with the local expenses, you are required to take the lesser of your actual costs in that category or the standard costs. For national expenses, you can take the national standard expenses even if you didn't pay as much as the standard amount. But for the local expenses, the amount you take on the form 433A OIC is the lesser of the standard amount or the actual amount you paid for such expense. So if we look at the 433A OIC here, section 7, under monthly household expenses, where we were before, lines 40, 41, 42, and 43, those are your local expenses. So let's go through these, starting with line 40, housing and utilities. And you can see on the form itself what is included in housing and utilities. So this is supposed to cover your rent or mortgage payments. That includes interest, average monthly cost of property taxes, home insurance, maintenance dues, fees and utilities, including electricity, gas, other fuels, trash collection, water, cable, television, internet, telephone, and cell phone. So what you do is compare your actual costs for all these expenses on a monthly basis. Obviously, if it's your rent or your mortgage, then from month to month, it's probably going to be the same. But for the other expenses that can vary a bit from month to month, just go ahead and average them over 6 to 12 months. And you compare the sum of all these expenses to the local standard expenses for housing and utilities for your location. And in general, you take the lesser of those two. Okay. In the description below, I have a link to the PDF with the local housing and utility standards for 2021. They're county by county. So I'm in Los Angeles County, California, so that's what I'm going to use here. The local housing and utility standard for Los Angeles County for a household size of 1 is $2,367. You can see the other amounts for other household sizes up to 5 persons. So if I'm a household of 1, just me, on line 40 of the form 433A, I would put the lesser of that amount, right, the local expense amount, $2,367, or, right, the lesser of that amount, or my actual average expenses on a monthly basis for all these things: rent, mortgage, property taxes, home insurance, etc. The list I read off the form earlier. So if my average monthly cost for all those expenses are $2,000, I would put $2,000, right? But if they're $3,000, I would put the local expense, right? $2,367 from the PDF that I linked to in the description below. That said, similar to the national standards, if you can make a case that you ought to be able to take more than the local standard expenses, you can make that argument. You can always reach out to taxrelief@loganalec.com to see if my team and I can help with that. For example, if you have physical disability or an unusually large family that requires a housing expense greater than the local standard, you may be able to deduct more than the local standard expense for housing and utilities for your area. Another example of a situation where you may be able to deduct more than the standard is if you have owned your home for several years, your monthly payment is above the standard, and you would not be able to rent an apartment in your area for less than your current monthly payment. Okay, so there's some fact patterns there that can allow you to deduct more than the standard amount. All right, let's move on to the local standards for transportation. These are reported on lines 41 through 43 of the Form 433A OIC. So the 3 lines here correspond to the 3 components of the local standard expenses for transportation, which are public transportation, ownership costs, and operating costs. Interestingly enough, public transportation costs and ownership costs, despite being grouped as local standards, public transportation costs and ownership costs actually have one standard, respectively, for the entire nation, okay? While operating costs are determined regionally. And yes, assuming you incur expenses for all 3, you can deduct all 3 on the form. I've seen some other information online, some other YouTube videos saying that, if you own a car, you can't take public transportation costs, and that's not necessarily true. You can see right here on the IRS Collection Financial Standards page that it says, if a taxpayer owns a vehicle and uses public transportation, expenses may be allowed for both, provided they are needed for the health and welfare of the taxpayer or family, or for the production of income. And that latter bit there, provided they are needed for the health and welfare of the taxpayer or family, or for the production of income, that's a very common refrain from the IRS when it comes to expenses you can deduct on your offer amount, okay? So what this is basically saying is, you can take all 3 kinds of expenses, right? The 2 vehicle expenses and the 1 public transportation cost. But, let's say all your public transportation costs on a monthly basis are attributable to you taking the train to go camping 2 weekends a month or something like that. I guess it'd be hard to go camping on the train with all your supplies. Anyway, if it's just for recreation, right, the IRS doesn't consider that necessary for the health and welfare of you or your family or for the production of income, right? So it has to be necessary, right? So it's the lesser of, right? If you own your car outright and don't make any monthly payments on it, you can't deduct any ownership costs because you don't have any ownership costs, okay? So here are the local standard expenses for transportation for the Los Angeles Metropolitan Statistical Area, MSA, where I live. Note that the public transportation costs and ownership costs are the same nationally. Only the operating costs are regionally determined. So let's go over the easy ones first. Public transportation costs and ownership costs. Let's start with public transportation, which you can see on line 43 of the Form 433A OIC. This is your average monthly cost of fares for mass transit, such as bus, train, ferry, taxi, etc. Not sure why they didn't put subway. I have a feeling that more people probably use a subway every day than a ferry to get to work. It says a reasonable estimate may be used. So for 2021, the standard monthly expense for public transportation is $217. So if you spend at least $217 a month on public transportation, you'd put $217 on line 43 because that's the max. If you spend less, then you put the actual amount you actually spent. Now, as I'm saying over and over, you can always make the argument or try to make the argument that you need to spend more than $217 a month on public transportation. And in fact, you do spend more than that amount on public transportation, but you need to be able to show proof of payment, documentation, and give a good reason why you need to spend more than the standard amount. It's usually related to, hey, I work really far away and I have to spend more on public transportation as a result. All right, now let's talk about ownership costs, which, like public transportation costs, are the same nationwide. So for 2021, the ownership cost for 1 car is $533, and the ownership cost for 2 cars is double that, $1,066. If you're single, by the way, you can only base your expenses on 1 car, even if you own multiple vehicles. The 2-car standards are only available to married taxpayers. However, the 1-car standard must still be considered on a per-car basis. For example, if you're married and your actual ownership costs for car A are $400 a month, and your ownership costs for car B are $800 a month, you can't claim the maximum 2-car ownership standard of $1,066 per month. You can claim $400 your actual expenses for car A, because the actual for car A is less than the local standard amount. And you can claim $533, right, which is the one car maximum for car B, because car B's actual expenses exceed the local standard amount, for a total of $933 in monthly ownership costs. Okay, monthly ownership costs are, your monthly payment on your car. If you don't have a monthly payment on your car, you don't have a monthly ownership cost on the form 433A OIC. But assuming you do have a monthly payment on your cars, once you determine your monthly vehicle ownership amount, as I just described, you put it on line 41 of the form 433A OIC, which is for vehicle loan and or lease payments. All right, so the last vehicle expense here is vehicle operating costs, which go on line 42. And unlike the public transportation costs and the vehicle ownership costs, the operating costs are regionally determined. But unlike the local housing standard expenses, the local transportation standard expenses for vehicle operating costs are determined at the region or the metropolitan statistical area level, rather than, strictly speaking, the county level. For example, if you look at the IRS page for these standards, link is in the description below, and you look at the table for MSA definitions by census region, MSA, of course, stands for Metropolitan Statistical Area. If you look at this table, and for example, you'll see the Los Angeles MSA for the vehicle operating cost standard includes, here in Southern California, Los Angeles County, Orange County, Riverside County, and San Bernardino County. So if you live in one of those counties, you would scroll up on this page and look at the operating cost table under West Region. You see Los Angeles, okay? And there are your local transportation standards for vehicle operating costs for Los Angeles MSA for 2021. Okay, $313 for one vehicle, $626 for two vehicles. Now, not every county in the United States falls into one of the metropolitan statistical areas on the IRS's MSA table. For example, here in California, the only three MSAs are Los Angeles, San Diego, and San Francisco, and combined, these MSAs only encompass 10 counties when there are 58 counties in the state of California. So what if you live in, say, Ventura County? Beautiful county here in Southern California. That's where my wife and I got married. Ventura County, if you look at the chart here, it's not in one of these MSAs in the West region on the IRS's website. So what do you do if your county doesn't fall into one of these MSAs? Well, in this case, you would use the standard for your entire region if there's no MSA-specific standard that your county falls into. So it says here the West Census region includes, and I have no idea how they ordered this. It's not alphabetical. It's not geographical. But the West Census region includes New Mexico, Arizona, Colorado, Wyoming, Montana, Nevada, Utah, Washington, Oregon, Idaho, California, Alaska, and Hawaii. So if I lived in Ventura County, I would scroll up to the operating cost table and simply use the West region standards, which are $242 for vehicle operating costs for one vehicle, and double that, $484 for two vehicles. And just like with the ownership costs, you can only use the two-car standards if you are married. And even if that is the case, each individual car is still limited to the one-car standard. Okay, so you'd use the lesser of these amounts or the actual amounts per car, slap that number on line 42 of the 433A OIC, unless you can show documentation and a good reason why you should be able to claim a higher operating cost expense than the standard. For example, if you can show that your higher costs are attributable to commuting costs necessary for the production of income and not, say, weekend road trips or something like that, you might have an argument there. Also, if your car is currently more than 8 years old or has reported mileage of 100,000 miles or more, you are generally allowed an additional monthly operating expense of $200 on top of the standard operating expense for your region or MSA. All right, now we move on to the other expenses. Line 44, health insurance premiums. That's just put whatever you actually pay out of pocket there. This is what you actually pay, not your employer or someone else, but what you actually pay for health insurance premiums every month. If you don't pay anything for health insurance premiums every month, you put zero. By the way, IRS tells you to put zero on every line that's actually zero. This is because if you put zero, that's a definitive, explicit response, right? But if you leave a line blank, you could say later, oh, I meant to put something there, but I forgot, right? I personally never had a problem leaving lines blank. IRS wants you to put zero if it's zero. That's just between you and me. And speaking of me, if you want to reach out to me and my team to help you with your back taxes and your tax situation, be sure to email me at taxrelief@loganalec.com. All right, court order payments, line 46. That's monthly alimony and or child support payments. These are generally allowed in full with a caveat here. For child support, for example, only the portion of the payment that's directly related to what the IRS considers necessary to the health and welfare of the child is permitted. For example, let's say you're ordered by the court to make a payment for a child's college tuition, and let's say you pay it dutifully every month. You can't deduct that just because it's pursuant to a court order, right? If the child lived in your household and you were paying for their college tuition, you couldn't deduct it either. And that doesn't change just because in your case it's pursuant to a court order. But in general, most general child support payments will count here. Also, this may be obvious, but I've had clients kind of push back on this for some reason. You do not get to take a deduction for these payments if you're not actually paying them, okay? If there's a court order for you to pay them, but you're not actually paying them, you don't get to deduct. You have to actually be making these payments in order to deduct them on the 433A OIC to determine your offer and compromise amount. All right, life insurance premiums, line 48. This is generally for reasonable term life insurance premiums. So if you have term life insurance, put your monthly premium on this line. Now, if you have whole life insurance with a cash surrender value, you put that as an asset in the equity section back up on line 4. I discussed how to value that previously in this video. All right, next up, line 49, current monthly taxes, which the form explains as monthly cost of federal, state, and local tax, personal property tax, etc. So if you have a W-2 job, this is basically what's being withheld from your paycheck every month for federal, state, and local income tax withholding. Okay, if your withholding amount doesn't really reflect your actual tax liability very well, i.e. you're substantially under withholding or over withholding, IRS may say, hey, we're just going to use your actual tax liability for the year divided by 12. Personal property taxes, that's like the property taxes you pay on, say, vehicles or boats and other assets like that. All right, secured debts and other, line 50. Let's start with secured debts. First of all, what does not go here is credit card payments. Credit cards are not secured debt. Credit cards are unsecured debt. And the IRS's rationale for not including credit card payments is that, well, we've already covered your necessary expenses through the other expense lines on this form. You can't double dip, right? If you used your credit card to buy food or to pay for public transportation, well, we've already accounted for those expenses on previous expense lines. So we're not going to let you deduct your credit card payments on top of that. So this line is only for secured debt and other expenses. I'll get into other expenses later, but it's not for unsecured debt, such as credit card debt, okay? So with secured debt, this doesn't include your mortgage payment, right? Because even though that's secured debt, that's already been accounted for in line 40, housing and utilities. This also doesn't include your car loan payments for the same reason, even though that is secured debt, that's already been accounted for in line 41, vehicle loan and or lease payments that we discussed previously. Because here in line 50, it says a secured debt is for any loan where you pledge an asset as collateral not previously listed, right? And we already listed, your housing, which would include your mortgage, and your vehicle ownership costs, which includes your car loan. Other requirement here, and this is a requirement for every expense you put in the 433A OIC, I've said this throughout this video, is that the debt, you must have taken it out to pay for necessary expenses, okay? Expenses needed for the health and welfare of you or your family or for the production of income. So what's an example here of a secured debt whose payment you can put here? Let's say use M1 Finance, one of my favorite stock investment platforms, linked to my reviews at the top of the screen and in the description below. Let's say you have a brokerage account at M1 Finance and you borrow against your brokerage account, and the proceeds of that loan were used to pay for some necessary medical procedure for your child or something like this, right? Well, that's an expense that's clearly for the health and welfare of your family, okay? So your monthly payment on that secured loan would be fair game here on line 50, right? But not a loan secured by your brokerage account that you took out to go on vacation. That wouldn't count. Now, what if you need to take out a loan secured by an asset to fund your offer and compromise? Like a second mortgage on your house, does that count? Well, yes, the IRS says that the monthly payment amount on secured loans taken out to pay for your offer and compromise is fair game. You can deduct the monthly payments on such loans here on line 50, but only if the asset itself is necessary for the health and welfare of you or your family, such as your home, obviously, and the repayment amount is reasonable. Now, what about 401k loans? That comes up a lot. Well, the IRS specifically says that payments made on loans from voluntary retirement plans will not be allowed. But they say that if you are going to default on this loan, you can include the tax consequences of the default as an additional tax expense for offer and compromise purposes. Determining the tax consequences on defaulting on a 401k loan is beyond the scope of this video. Perhaps that warrants its own video. If you have any questions about that or about anything else pertaining to tax relief, email me, taxrelief@loganallen.com. But now I'm going to move on from unsecured debts here and talk about what could go into the other portion of line 50. So when you see other, you might be thinking, oh, I can put everything I want here. No, this isn't everything in the kitchen sink. These are only expenses that don't fit on another line here that are necessary by IRS standards. Okay. Example right here in the form government guaranteed student loans. The IRS's guidance on this says that this is for minimum payments on student loans guaranteed by the federal government for post-high school education. Proof of payment must be provided. If you're not actively making payments, you don't get to deduct any amount here unless, and this is a rare exception, unless non-payment is due to circumstances of financial hardship, such as unemployment, or you have a lot of medical expenses due to a health issue or something like that. Usually the IRS says you have to, actually be making the payments in order to deduct it. This is a rare exception. Another example right here in the form is employer required retirement or dues. This is not referring to voluntary retirement. So your voluntary contributions to your 401k don't count. But if your employer requires you to, say, contribute a certain amount of money every month to your retirement, or requires you to pay some dues, union dues or something like this, that would count. Employer required retirement or dues, that pertains to production of income. So IRS accepts that. What about education expenses, tuition payments and all that? I talked about student loan payments previously, but what about if you're in school now and you're making tuition payments or other education related expenses? So the IRS guidance says that education expenses are only allowed if they are required as a condition of present, not future, present employment. For example, your job says, hey, you need to get this degree or this certification right now. You need to enroll in this program right now, or you're going to lose your job. That is clearly required for your present employment. In that case, your education expenses would be fair game. Now, paying college tuition for yourself, that's not necessary for your job, but you're getting this degree in hopes of getting a better job, that doesn't count. Paying your child's college tuition does not count. Paying tuition for your child's private school does not count unless your child has special needs that cannot be met by the public school system. Now, what about charitable contributions? People always ask about these. I think it's because charitable contributions are a deduction on Schedule A of your tax return if you itemize your deductions. But for offer and compromise purposes, charitable contributions are generally voluntary and not necessary to the health and welfare of you and your family or to the production of income. However, if charitable contributions are a condition of your employment, for example, if you're a pastor or a priest or some other religious leader, and part of your employment agreement is that you have to give a certain amount or percentage every month to your religious institution, in that case, your charitable contributions would be considered an expense necessary to your production of income. It's a condition of your employment. That would therefore be permitted as an other expense on line 50 here. All right, let's go to line 51. Enter the amount of your monthly delinquent state and or local tax payment. So it can get a little hairy. Just because you're making payments to state and local taxing authorities doesn't mean you get to put the entire amount here. It depends on whether or not you have an agreement with the state and local taxing authority itself. If you don't, it doesn't matter how much you actually pay to your state or local taxing authority on a monthly basis. You have to use a formula put out by the IRS to determine the amount to put here on line 51. That formula is basically you taking your monthly disposable income and multiplying that figure by the ratio of how much you owe the state over how much you owe the state and the IRS combined. If you do have an agreement with your state or local taxing authority, you have to look at the date the agreement was established, because there are different rules depending on if your agreement with the state was established prior to the IRS earliest date of assessment for federal tax liability, in which case you could just take the amount you pay per the agreement, or if your agreement with the state was established after the earliest IRS date of assessment, in which case you'd use the lesser of the calculated amount per the calculation I just told you about previously, or the actual amount you pay the state every month per the agreement. So this stuff can get a little hairy. If you want a professional in your corner here for stuff like this, email me taxrelief@loganout.com. Tell me a little bit about your situation. All right, so at this point, we've gone through all the expense lines 39 through 51. Then in box E, you sum them all up. You add up all the amounts in lines 39 through 51. Put that sum in box E. Then you subtract this amount in box E from the total household income that you came out with in box D previously. That difference goes in box F. If the amount is negative, meaning box E is greater than box D, you just put 0 in box F. You don't put a negative number, but otherwise you put the difference. All right, now that you've determined your excess monthly income here in box F, you have to multiply it by a future income multiplier of either 12 or 24 months to arrive at the income component of your reasonable collection potential to calculate your offer amount. Now, 12 months is obviously preferable to 24 months, because if you use 12 months, your offer amount will naturally, mathematically, only include half the income component than if you were to use 24 months. But to use 12 months, the 12-month multiplier, you have to pay your offer off within 5 months after offer acceptance. So on the screen here, I've shown you your two options when it comes to offers and compromise. So the first kind of way you can make your offer payment is the lump sum cash offer, in which the offer amount is paid in a lump sum of no more than 5 monthly installments within 5 months after offer acceptance. You must also include a down payment of 20% of your offer amount along with your offer, and the IRS keeps this down payment even if they reject your offer. Okay, I covered that more in my previous video on offer and compromise basics. Link to that video is in the description below. Also in that video, I talked about the low income certification, where if you qualify for low income, you don't have to make the down payment. Okay, so anyway, if you go this route, pay your offer amount within 5 months after offer acceptance. You only have to multiply your income in box F by 12. However, if you need longer to pay your offer amount, if you need more time to pay your offer, then you have to go to the periodic payment offer route, in which your offer amount is paid in more than 6 monthly installments within 24 months after your offer is accepted. And in this case, you don't have to make a down payment, but you must make monthly payments while the IRS is considering your offer and obviously thereafter. And if you go this route, you have to multiply your income by 24 in order to come up with your remaining income. So that's what's going on here in Section 8 of the Form 433A OIC, where you have these boxes here, these 4 boxes. This one says enter the total from box F times 12 equals box G, future remaining income. This is if you're going the lump sum cash offer route. Then below that pair of boxes says enter the amount from box F times 24 equals box H, future remaining income. That's if you go the periodic payment offer route. You don't fill out all 4 of those boxes. You fill out the top 2 here if you're doing the lump sum cash offer, paying within 5 months and submitting a 20% down payment. You fill out the bottom 2 here if you're doing the periodic payment offer, paying within 24 months. And then in the final set of boxes here in Section 8, you simply take your equity component, right, your available equity and assets from box A that I showed you how to calculate previously in this video, plus box B, which is your equity in business assets, which I didn't go over in this video because, like I said, I want to do a separate video specifically for business owners, how they can determine their equity in business assets and business income for offer and compromise purposes. Basically, you add box A and box B, you put that sum in the box that says, no surprise, enter the amount from box A plus box B. And then the second box here at the bottom of Section 8, the box that says enter the amount from either box G or box H. Obviously, you'd put the amount from box G if you're doing the lump sum cash offer, and you'd include the amount from box H if you're doing the periodic payment offer. Then you add these 2 boxes together, and voila, you have the amount of your offer and compromise. So there you have it, folks. That's how you determine your offer and compromise amount for a doubt as to collectibility offer and compromise. Obviously, there are other informational sections on the Form 433A OIC that you would have to fill out. There's the Section 9 after Section 8. There's Section 10 with the signatures. There's some sections at the beginning of the form. You also have to fill out the Form 656. I will be doing full example walkthroughs of every single section of these forms here in the near future in the next few weeks. Hopefully those videos will be shorter than this one, right? Because in this video, we had to work through a lot of the framework here that you have to know in order to fill out the forms correctly. You have to know this stuff before you jump right into the forms, okay? Also, be sure to watch my previous video on the offer and compromise basics, where I tell you, among other things, what you need to include in your offer and compromise package to the IRS. You can click right over here to watch that video. Be sure to subscribe to the channel as well so you don't miss all the future tax relief videos I am going to publish here. And be sure to email me at taxrelief@loganallen.com if you want a professional to handle your offer and compromise so you can make sure it's done correctly so you don't waste your time and you don't waste your money. Thank you so much for watching, everybody. I'll see you in the next video. Bye-bye.